The European Union is considering a new 0.1% tax on crypto transactions as part of a broader effort to fund its next long-term budget. This move is part of a larger financial package that also targets digital services and online gambling. The tax could generate between €3 billion and €4 billion annually, with an additional €1 billion to €2.4 billion potentially coming from a capital gains model. Over the 7-year budget cycle from 2028 to 2034, the crypto-related portion could bring in as much as €20 billion. This is a significant figure, especially when compared to the estimated €35 billion from digital services and €13 billion from online gambling. The scale of these potential revenues is pushing crypto taxation into the center of the EU's budget discussions. This isn't just a compliance matter anymore. It's shaping the future of how the EU funds itself after 2027. The transaction tax model, which focuses on the value of crypto trades, is straightforward in theory but complex in practice. High-frequency trading, arbitrage, and automated strategies can create large volumes of notional activity with minimal profit margins. This makes it hard to apply a flat. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Tax rate without distorting market behavior. The capital gains approach, on the other hand, would target realized profits from crypto assets. This model is more familiar in traditional markets, but it still requires a unified EU tax framework and better cross-border data sharing. The EU's interest in crypto taxation is not new. An earlier paper explored how digital asset activity could serve as a direct revenue source at the EU level. Now, the focus is on making that vision a reality. The transaction tax would apply to trading activity, meaning the EU would take a small cut from the value of each trade over a defined period. This is different from traditional tax models that focus only on profits. The simplicity of the idea is appealing, but the execution is anything but. The challenge lies in distinguishing between genuine profit and notional turnover, especially in markets where automated trading is the norm. The capital gains model is more aligned with existing tax structures, but it still requires a harmonized EU tax base and better coordination between member states. The EU's push into crypto taxation is part of a broader strategy to expand its fiscal tools. As digital assets grow in size and influence, the EU is positioning itself to capture a share of that economic activity. This is not just about raising money, it's about asserting control over a sector that is increasingly global and decentralized. The next signal to watch is how the EU's proposed tax framework will interact with existing regulations like MiCA, the Markets in Crypto Assets Regulation. The final shape of the tax could depend on whether the EU prioritizes simplicity or alignment with traditional financial systems. The stakes are high, not just for crypto. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Traders, but for the entire digital economy. The EU's ability to tax crypto could set a precedent for other regions and influence the global regulatory landscape. The uncertainty lies in how the tax will be applied in practice and whether it will be effective without stifling innovation. The next major development will likely come from the EU's formal budget proposals, which are expected to be drafted in the coming months. Traders and investors should monitor how the final tax models evolve and whether they include exemptions or thresholds to reduce the burden on smaller participants.